Friday afternoon at exactly 2 o'clock, the financial world changed forever in a single heartbeat. A single push notification on a social media app destroyed billions of dollars in paper wealth instantly. President Donald Trump finally revealed his long-awaited pick for the next chair of the Federal Reserve. The name was not the easy money loyalist that Wall Street had desperately priced in for months. It was Kevin Warsh, the former governor, known for his aggressive hawkishness and disdain for money printing. The high-frequency trading algorithms read the headline and immediately triggered a nuclear sell-off event. Silver, which had been touching a historic $121, collapsed instantly into a freefall. In a matter of minutes, the price plummeted 37% to $76, wiping out months of gains. This was the single most violent repricing event in modern commodity history, shocking even the most veteran traders. It wasn't just a healthy market correction, it was a total regime change in global liquidity expectations. The market realized in a split second that the Fed put is officially dead and buried. Kevin Warsh is not coming to print money to save stocks. He is coming to burn it. He has explicitly stated in recent interviews that the Federal Reserve needs a complete and total regime change. This specific phrase terrified the trading bots that control the leverage in the paper silver market. They dumped every long position they held, fearing a massive liquidity drain that would dry up the system. The result was a flash crash that left retail investors stunned, bleeding, and looking for answers. But if you understand the history of Kevin Warsh, this violent reaction was entirely predictable and inevitable. He is the man who famously warned Ben Bernanke about the dangers of inflation back in 2010. Before we dive into the terrifying mechanics of this crash and what comes next, I need you. Please subscribe to the channel right now and turn on the notifications to stay ahead of the crowd. The algorithm is actively suppressing this video because we are exposing the central bank's inner workings. And leave a comment below with the city you are watching from today so we can track our reach. To truly understand why silver crashed so hard, you have to understand the specific Warsh doctrine. For months, the market believed Trump would pick a candidate who would slash interest rates to zero. Traders leveraged themselves to the hilt, betting on a future of infinite cheap money and currency debasement. Silver soared to record highs on this assumption of endless inflation and a compliant Federal Reserve chair. But Kevin Warsh represents a terrifying curveball for the leveraged paper speculators who were caught offside. While he supports tax cuts, he hates the Federal Reserve's bloated balance sheet with a passion. He believes the Fed has expanded its power far beyond its legal mandate and needs to be reined in. He wants to strip the Fed down to its bare bones and stop meddling in the financial markets. This means ending the purchase of mortgage-backed securities and treasury bonds immediately, effectively stopping the printer. When the Fed stops buying bonds, liquidity evaporates from the system instantly, leaving risk assets vulnerable to collapse. The algorithms know that silver creates no yield and relies on excess liquidity to sustain high valuations. So, when Warsh was announced, the machines calculated a massive liquidity drought coming down the pipeline. They sold silver to buy United States dollars, spiking the currency index violently to new yearly highs. The dollar index ripped higher, acting like a wrecking ball to commodity prices across the board. This inverse correlation between the dollar and silver is the most powerful force in global financial markets. When the dollar spikes on hawkish news like this, silver is always the first casualty to fall. But the sheer violence of this particular move suggests something much deeper is broken in the market structure. A 37% drop in a few hours implies that there were absolutely no buyers stepping in. The order book simply evaporated, leaving a vacuum of air under the price that accelerated the decline. This is exactly what happens when a market is built on leverage rather than fundamental value. The longs were liquidated in a cascade that hunted for stops all the way down to $76. But here's the twist that the mainstream media is completely missing in their coverage today. Kevin Warsh is actually a believer in a stable, sound currency over the long term. He has criticized the Fed for allowing inflation to destroy the purchasing power of the middle class. His appointment is actually bullish for silver in the long term, not bearish as the price suggests. He wants to restore credibility to the dollar, which eventually exposes the massive national debt problem. If he stops the money printer, the interest on the national debt explodes to unsustainable levels. The United States government cannot afford real interest rates with $36 trillion in debt. So the market is crashing because it fears Warsh will actually do his job and fight inflation. He might be the Paul Volcker of our generation, willing to crash the market to save the dollar. Volcker raised rates to 20% in 1980 to kill inflation for good, causing a massive recession. That move crashed gold and silver temporarily before they found a true bottom and began a new cycle. We are seeing a historical echo of that 1980 pivot playing out right now in real time. The difference today is that the United States is bankrupt and cannot survive high interest rates for long. Kevin Warsh knows this, which makes his nomination a game of 4D chess by Donald Trump. Is he being brought in to crash the system on purpose, to reset it for a new era? Or does Trump believe that Warsh can magically cut rates without causing a massive spike in inflation? The market voted yesterday with a resounding no to the soft landing narrative that everyone hoped for. They believe Warsh is going to break something in the plumbing of finance to restore order. And the first thing he broke was the paper silver market on the Comex exchange in New York. But while the paper market burned, the physical market did something incredible and telling on Friday afternoon. Bullion dealers did not lower their prices to match the panicked futures market on the screen. They held their premiums high, creating a massive spread between the paper price and the physical metal. This Warsh spread is the new reality we have to navigate as investors in this volatile environment. It signifies that the physical market does not believe the price on the screen is legitimate anymore. They know that a hawkish Fed chair cannot print silver molecules out of thin air to meet demand. Warsh can destroy the paper price with a single speech, but he cannot create new silver supply. The mines are still depleting and the solar panels still need the metal to function effectively. Samsung and Tesla do not care who the Federal Reserve chairman is today or tomorrow. They only care if they can get the silver they need for their production lines to keep running. And right now, the crash has made physical silver harder to find, not easier, for these industrial giants. Sellers have gone into hiding, refusing to sell their hard assets at these artificially suppressed levels. This supply shock is going to collide with the paper crash very soon, creating a massive squeeze. When the dust settles, the Warsh crash will be seen as a classic bear trap for retail investors. It flushed out the weak hands who were betting on a pivot narrative that turned out to be false. It transferred the metal to strong hands who understand the structural deficit reality of the silver market. But the pain is real for anyone who was holding a leveraged call option during the drop. Those accounts were wiped to zero in the blink of an eye yesterday, leaving nothing behind. This is why we always warn against playing the casino games of the bankers with leverage. They own the casino, and they can change the dealer whenever they want to stack the deck. Trump changed the dealer to Kevin Warsh, and the House swept the table clean of all players. But the game is far from over. In fact, it is just beginning for the astute investor. The bond market is the next domino that is going to fall hard in this chain reaction. Warsh has been a vocal critic of financial repression by the central bank for over a decade. If he stops repressing yields, the 10-year Treasury yield could soar to 6% or higher. That would bankrupt the U.S. government and force a default or a massive pivot back to printing. The market is currently pricing in a hard landing recession caused by Warsh's tight monetary policies. In a recession, industrial demand for silver drops, which adds to the selling pressure in the short term. But silver is also a monetary metal, a safe haven against sovereign default and currency debasement risks. If Warsh forces the U.S. government to face its debt reality, confidence in the system will collapse. Capital will flee the bond market and look for assets with no counterparty risk, like gold and silver. That is where silver shines, regardless of what the nominal interest rate is set at by the Fed. The initial shock is painful, but the fundamental thesis remains completely intact and stronger than ever. We have to look at what Warsh did in 2008 to understand his potential playbook for 2026. He was the liaison to Wall Street, the guy who orchestrated the bailouts and saved the banks. He knows where the bodies are buried in the banking system better than anyone else in Washington. He knows that the banks are insolvent and cannot handle a massive balance sheet reduction right now. So why did he accept the nomination if he knows it is a trap for him? Perhaps he has a plan to implement a new monetary standard from the ashes of the old system. He has written favorably about the gold standard and stable money in the past, surprising many economists. If Warsh is a closet gold bug, this crash is the ultimate misdirection to shake out the speculators. He is shaking the tree to see who is holding real value and who is holding paper promises. The paper traders ran for the hills, but the physical stackers stood their ground and bought more. We are watching a high-stakes poker game between the Fed and the bond vigilantes play out live. Silver is simply the chip they are using to keep score right now in this global game, but the chip is being devalued on the screen while gaining value in reality and industrial utility. The 37% drop is a paper event, not a physical molecule event, and that distinction is critical. The molecules are still there, and they are still needed for the future economy to function properly. Warsh cannot change the laws of physics or the chemistry required to build high-efficiency solar panels. He can only change the cost of money, which is a temporary variable in the grand scheme. The deficit in silver is a permanent variable that will outlast his tenure as Federal Reserve Chair. But for the next few weeks, volatility is going to be extreme and likely terrifying for many. You must be prepared for swings that will test your stomach and your resolve to hold on. The Warsh volatility is the price you pay for betting against the corrupt financial system we live in. They will try to buck you off the horse before the finish line to steal your position. But if you hold on, the reward will be a generational wealth transfer unlike anything we have seen. To understand why the silver shortage is forever, we must look at the distressed balance sheets of the global banking sector. The appointment of Kevin Warsh is not just a political move, it is a regulatory earthquake for the too-big-to-fail institutions. For years, major banks like JP Morgan and Citibank have operated under the assumption that the Federal Reserve would never let them fail. This moral hazard allowed them to hold massive, risky positions in derivatives, including billions of dollars in paper silver contracts. But Warsh has been a vocal proponent of the Basel III endgame, a set of rules requiring banks to hold significantly more capital. He believes that banks should be fortresses, not casinos, and he intends to force them to prove their solvency immediately. On Friday morning, risk management desks across Wall Street likely received a memo to de-risk their books ahead of the transition. When a bank needs to reduce risk-weighted assets quickly, they do not sell their liquid real estate or long-term corporate loans. They sell their most liquid and volatile assets first, and for many trading desks, that meant dumping their precious metals books. This creates a terrifying picture where the price of silver in your pocket is determined by the regulatory compliance of a few banks. But while the American banks were selling to satisfy the new sheriff in town, a much larger disaster was unfolding in Tokyo. We have uncovered evidence that a massive Japanese institution, the Norinchukin Bank, was the whale that broke the market. Norinchukin is often called the CLO whale because they hold a massive portfolio of collateralized loan obligations in U.S. treasuries. They bet the farm that U.S. interest rates would fall, increasing the value of their massive bond holdings. But the nomination of Kevin Warsh signaled that rates are staying higher for longer, devastating their bond portfolio's value instantly. By mid-afternoon, rumors were swirling that Japanese regulators were demanding Norinchukin raise capital to cover a $20 billion hole. To stay afloat, they were forced to liquidate their crown jewels, creating a massive sell order that hit the silver market at the worst possible time. This was not a strategic decision based on the fundamental outlook for silver or any analysis of the metal's true value. It was a forced liquidation event driven by sheer desperation and the need to survive a regulatory capital call from Tokyo. The sharks on Wall Street, specifically the high-frequency trading desks in New York, saw this massive order flow hitting the tape. They immediately recognized the smell of blood in the water and knew a whale was puking its entire position into a thin market. So they shorted the market aggressively to front-run the liquidation, driving the price lower to profit from the Japanese bank's misery. They effectively kicked a man while he was down, using the Japanese bank's distress to trigger the retail margin calls that followed. This predatory trading is legal, but it creates a price signal that is completely divorced from the reality of supply and demand. But while the paper market was being destroyed by these banking games, the physical market was reacting in an explosive way. As the price crashed to $76, a massive wave of buying interest emerged from the most unexpected place, Costco. On Saturday morning, the wholesale giant listed 100,000 tubes of silver eagles on their website at the new crash prices. In a normal market, this amount of inventory would take days or even weeks to sell through completely to their members. But according to leaked internal data, the entire inventory of 100,000 tubes was sold out in less than 4 minutes. This was a frenzy of buying that crashed their payment processing servers and left millions of customers refreshing their screens in vain. It proves that the average American is waking up to the scam and is eager to exchange paper currency for real metal. Costco is now reportedly trying to source more metal, but the U.S. Mint has told them there's simply no product available. This creates a bottleneck where the demand is infinite, but the supply is zero, yet the price on the screen continues to drop. It is a paradox that can only exist in a manipulated system, but it also creates a massive opportunity for arbitrage. While Americans were fighting over tubes of coins, the industrial giants of the world were quietly making their own strategic moves. We have received intelligence that Samsung has dispatched a team of procurement officers to Mexico City to negotiate directly with miners. Samsung's new solid-state battery technology, set to launch in the Galaxy series, utilizes a silver carbon composite anode for higher density. This single technological shift is projected to consume 16,000 metric tons of silver annually, if adopted by the broader EV market. Samsung knows that they cannot rely on the Comex to deliver this metal because the vaults in New York are effectively empty. If they rely on the paper market, they risk shutting down their production lines, costing them billions in lost revenue and market share. So they are bypassing the market entirely, offering miners a premium above the spot price to secure exclusive rights to production. This is the beginning of the offtake war, where tech giants consume the supply before it ever reaches the public markets. When Apple, Tesla, and Samsung start fighting over silver mines, the price on the Comex becomes completely irrelevant to reality. We are already seeing this with the solar industry, which is in a state of absolute panic regarding silver paste supply. The industry has shifted almost entirely to TOPCon bifacial solar cells, which are more efficient but require 50% more silver. Solar manufacturers were banking on the price of silver staying low, but they were not banking on the physical disappearance of the metal. The crash to $76 has actually hurt them because it has discouraged recycling centers from processing old electronics and panels. At low prices, it is not profitable to extract silver from e-waste, so the recycling supply chain has effectively shut down overnight. This removes roughly 20% of the global silver supply from the market at the exact moment demand is hitting a peak. The lower the paper price goes, the tighter the physical market becomes, creating a coiled spring ready to explode upwards. But perhaps the most damning evidence of the broken market is what is happening right now on the Shanghai exchange. While New York traders were selling paper contracts in a panic, Chinese traders were buying physical metal with both hands. The price of silver in Shanghai is currently trading $26 higher than the price in New York, a massive arbitrage. This means you could theoretically buy a bar in New York for $76 and sell it in Shanghai for $102. This arbitrage window acts like a giant vacuum cleaner, sucking every available ounce of silver out of the West instantly. Smart money is taking delivery of Comex contracts, loading the bars onto armored transport planes, and flying them directly to Shanghai. This is draining the Comex vaults at a record pace, leaving the exchange with nothing but paper promises and empty vaults. The registered silver category, which represents metal available for immediate delivery, has dropped to levels not seen since the 1970s. If this drain continues for another month, the Comex will face a force majeure event where they cannot fulfill delivery obligations. They will be forced to settle contracts in cash, effectively admitting that they have run out of silver and defaulted on the market. This would be the end of the US dollar's dominance in commodity pricing and the beginning of a BRICS-led commodity era. China knows this, which is why they are not crashing the price. They are letting the West crash it for them. They are happy to buy our silver at a discount, knowing that it is the strategic metal of the future economy. The transfer of wealth is happening in plain sight, and the US regulators are either too incompetent or too corrupt to stop it. But the fraud goes even deeper than the exchanges. It extends into the so-called secure vaults of Switzerland and London. We are hearing horror stories from wealthy investors who hold allocated accounts with major Swiss storage firms in Zurich. An allocated account is supposed to mean that you own specific numbered bars that are set aside solely for you. But when these investors tried to withdraw their metal during the panic, they were hit with delays and bureaucratic roadblocks. Some were told that their bars were being audited, while others were offered a cash settlement instead of their physical metal. This implies that the vaults have been leasing out the allocated bars to short sellers, selling the same bar twice. This is the classic definition of a Ponzi scheme, but it is being run by the most prestigious financial institutions in the world. If the allocated accounts are empty, then the unallocated accounts, where you just have a claim, are certainly worthless to you now. This realization is triggering a bank run on the private vaults as everyone rushes to verify their gold and silver holdings. The trust in the custodial system has been shattered, and once that trust is gone, it can never be restored. This is why we always say, if you don't hold it, you don't own it, because possession is the only law that matters. The paper claims will be settled in depreciating currency, but the physical metal will be repriced to reflect true scarcity. And that repricing is coming sooner than anyone thinks, driven by a geopolitical shock that is brewing in Latin America. While we focus on Japan and China, a massive storm is forming in Mexico and Peru, the largest producers of silver. The miners in these countries are watching the price crash with fury, knowing that $76 is below their cost of production. They are losing money on every ounce they dig out of the ground, and they are refusing to subsidize the West any longer. Major unions in Peru have already announced an indefinite strike, blocking ports and shutting down the export of silver concentrate. They are demanding that the price return to $100 before they lift a single finger to move metal again. This Peruvian roadblock is choking off supply to the refineries, which will soon lead to shortages of industrial 1,000-ounce bars. But the situation in Mexico is even more dangerous, as the government is now getting involved in the mining sector directly. Rumors are leaking from Mexico City that the administration is drafting legislation to classify silver as a strategic national resource. This would be the first step towards nationalization, similar to what they did with their lithium deposits in previous years. If Mexico nationalizes its silver mines, they could slap a massive export tax on the metal or ban exports entirely. Mexico produces nearly 25% of the world's silver. If they exit the market, the global supply chain collapses instantly. The price would not just recover to $120, it would likely gap up to $300 overnight. This is the black swan event that the algo traders in New York are not pricing into their risk models. They are looking at charts and moving averages, while the physical supply chain is being dismantled by angry miners and governments. The disconnect between the digital world of high finance and the physical world of mining has never been wider than it is now. And when that gap closes, it will snap shut with enough force to bankrupt every short seller in the market. We are standing on the precipice of a supply crunch that will make the 1970s look like a minor correction in comparison. The shelves at Costco are empty, the vaults in London are draining, and the mines in Peru are shutting down production. Yet the price on your screen tells you that silver is in a bear market, and you should sell immediately. This is the ultimate test of your conviction and your ability to see the truth through the lies of bankers. The silver rug pull was designed to scare you out, but for the educated investor, it is the final signal to buy. They are trying to shake you out because they know what is coming next, and they want your seat at the table. But there is one final piece of the puzzle that explains why they are so desperate to keep prices down right now. It involves a deadline that is approaching in March, a deadline that the Comex cannot avoid or delay any longer. The open interest for March delivery is currently 3 times larger than the amount of silver available in the vaults. If those contract holders demand delivery instead of rolling over, the exchange will default and the game will end. The sun is about to rise on what promises to be the most chaotic Monday morning in the history of the commodities market. While the markets are technically closed for the weekend, the shadow banking system never sleeps. The panic is already spreading. Traders are currently staring at their screens in London, Singapore, and New York, waiting for the electronic markets to reopen in Asia. The Monday Open is going to be a moment of truth that will either confirm the crash or trigger a legendary reversal. We are already seeing indications from the gray market that the price of silver is going to gap down at the open. A gap down is when the price opens significantly lower than where it closed on Friday, skipping all the price levels in between. This is the ultimate nightmare for anyone holding a leveraged long position over the weekend, as there is no chance to exit. They will be trapped in their positions, facing immediate margin calls that must be met with cash within the hour. This Margin Call Monday is designed to flush out the last remaining speculators who refuse to sell on Friday. The banks know that retail traders are praying for a bounce, so they will likely push the price lower to break their spirit. But while the paper price might dip lower in the early hours of Monday, the physical market is signaling a massive squeeze. We have received reports that major bullion dealers have spent the weekend frantically calling mints to secure inventory. They are not calling to sell, they are calling to buy everything that isn't bolted down to the floor. They know that when the public wakes up on Monday and sees the price, the buying frenzy will empty their shelves in hours. This disconnect between the paper open and the physical open is where the real profit opportunity lies for us. The paper price is reacting to the Kevin Warsh nomination and the fear of a liquidity withdrawal. But the physical price is reacting to the reality that you cannot print silver and the world is running out of it. The March futures contract is the specific battlefield where this war between paper and physical will be decided. In the futures market, the active month is the contract that has the most volume and is approaching delivery. Right now, the March 2026 contract is the front month, meaning it is the price you see on your screen. Typically, traders will roll their positions out of March and into May to avoid taking delivery of the metal, but the data shows that open interest in the March contract is not dropping as fast as it usually does. This implies that there are entities, likely industrial users, who intend to stand for delivery next month. They do not want cash, they want the metal, and they are using the dip to grab contracts on the cheap. If these industrial users stand for delivery, the Comex will have to find millions of ounces of silver in weeks. The registered stocks in the Comex vaults are sitting at multi-year lows, leaving very little room for error. If the requests for delivery exceed the available metal, the exchange will be forced to declare a force majeure. This legal clause allows them to settle the contract in cash, effectively defaulting on their obligation to deliver metal. A default on the March contract would send shockwaves through the global financial system that would dwarf Friday's crash. It would prove that the price of silver has been suppressed by selling paper claims that have no backing. This is why the next few weeks, leading up to the March delivery deadline, are the most critical in history. The banks are desperate to shake you out before that deadline arrives, so they can reclaim the contracts. They need your silver to cover their naked shorts before the industrial buyers come knocking on the vault door. That is why they engineered the crash on Friday, and that is why they will likely hammer the price on Monday. It is a desperate game of musical chairs, and the music is about to stop for the paper shorts. But there is another massive catalyst lurking in the background that could trigger a reversal sooner than March. The yield curve in the bond market is steepening rapidly in response to the Warsh nomination. A steepening curve usually signals that the bond market is sniffing out a recession or a debt crisis. If the bond market breaks, the Federal Reserve, even under Warsh, will be forced to pivot back to printing. They cannot allow the U.S. Treasury market to fail, as it is the foundation of the entire global financial system. The moment the market sniffs a pivot, the dollar will collapse, and silver will slingshot to new all-time highs. We are seeing the early signs of this pivot panic in the currency markets of emerging economies. Currencies in Turkey, Argentina, and Brazil are crashing against the dollar, driving their citizens to gold and silver. This global demand for precious metals is the floor that will support the price, no matter what the Fed does. The world is losing faith in fiat currency, and a 37% drop in silver does not change that fundamental trend. In fact, it accelerates the trend by allowing the global south to buy more metal for less paper. We are witnessing a wealth transfer from the leverage-addicted west to the resource-hungry east. China, India, and Russia are accumulating commodities while Americans speculate on tech stocks and options. This imbalance is unsustainable, and the correction will be violent when it finally arrives. The crash of January 30th was just the opening salvo in a much larger currency war. You must ignore the noise of the daily price fluctuations and focus on the signal of physical scarcity. The signal is flashing red, telling us that the vaults are empty and the miners are tapped out. The paper price is a distraction, a magic trick designed to make you look at the wrong hand. Look at the other hand, the one that is quietly moving the physical bars from London to Shanghai. That is where the truth lies, and that is where the future price of silver will be discovered. The Monday Open will be scary, volatile, and likely manipulated by the algorithms to induce maximum fear. But if you can keep your head while everyone else is losing theirs, you will spot the entry of a lifetime. The smart money waits for the panic to subside and then steps in to buy the blood. They know that the cure for low prices is low prices because it kills supply and stimulates demand. At $76, silver is now trading below the all-in sustaining cost of many marginal mines. This means mines will shut down, supply will drop further, and the shortage will intensify. Economics 101 dictates that when supply falls and demand remains constant, price must rise. It is not a matter of if, but when, and the when is likely closer than the bears think. The V-shaped recovery from this crash could happen as early as mid-February. Once the margin call selling is exhausted, there will be no one left to sell at these levels. The market will run out of sellers, and the buyers will have to bid the price up to find liquidity. This liquidity vacuum works both ways. It caused the crash, and it will cause the melt-up. We saw this exact dynamic in March 2020, when silver crashed to $12 and then rocketed to $30. The people who bought at $12 made fortunes. The people who sold lost everything. History is offering you a second chance to be on the right side of the trade. Do not let the scary headlines about Kevin Warsh or the Fed distract you from the math. The math says that we are consuming more silver than we are producing, and the deficit is growing. The math says that debt is compounding faster than GDP, and the currency is mathematically doomed. The math says that silver is the most undervalued asset on the planet relative to the money supply. The crash was a gift, a chance to lower your cost basis and increase your ounce count. But you have to act before the window closes because the physical market is tightening by the hour. I will be monitoring the Monday Open live, tracking the order flow and the inventory levels. I will be watching the March contract specifically to see if the open interest starts to drop or hold steady. If the open interest holds, we know the squeeze is on and the banks are in trouble. If the open interest drops, we know the speculators are washing out and the bottom is near. Either way, we will have the data we need to make informed decisions, not emotional ones. The emotional trader sells the bottom, the informed investor buys the fear. There's a lot of fear in the market right now, which means there's a lot of opportunity. Do not let them shake you out of your position just days before the reversal begins. Hold your ground, trust your research, and remember why you bought silver in the first place. You bought it because the system is broken, and Friday's crash just proved how broken it really is. A functioning market does not crash 37% on a single news headline. A functioning market discovers price based on supply and demand, not algorithmic flow. We do not have a functioning market, which is why we must hold the physical insurance. The Monday morning massacre will pass, the dust will settle, and the metal will still be there. The fiat currency will continue to rot, and the debt will continue to mount. Nothing has changed fundamentally, except the price is now on sale for a limited time. Take advantage of their desperation and use their manipulation to your benefit. We are in this together, a community of individuals fighting for financial truth. Thank you for watching, for sharing, and for refusing to be a victim of the banks. Please hit the like button to help this video reach the people who need to hear it most. And make sure you are subscribed so you get the alert the moment the market opens on Monday. We will be here tracking every tick, every trade, and every ounce. Stay safe, stay stacked, and I will see you on the battlefield when the bell rings.